Howard Marks is a legendary investor and co-founder of Oaktree Capital Management. Whenever he publishes one of his memos to investors, everybody pays attention, and one of his most avid readers is none other than Warren Buffett. So in this video, we look at his latest missive, which is called Sea Change, and it's about a radical change in markets which is going on right now. We look at what he says and what it means to us as investors. This video is sponsored by NordPass, which lets you securely manage your passwords across multiple platforms. So let's look at Howard Marks's Sea Change in a bit more detail. So here is Howard Marks being interviewed on CNBC, and in fact his background is really interesting. He's worked in the investment industry for over 50 years, so he's seen many crises come and go, and I'd say his specialty is in the corporate bond space. So this would be either distressed debt, where a company's issued some debt, run into financial troubles, and then its debt becomes hugely discounted. And what he's very good at is selecting the companies which are going to make it out of that crisis. He's also very good at macroeconomics and working out where we are in the credit cycle, but also the economic cycle. So I think he's very useful to listen to when it comes to finding turning points. And what he's saying right now is that we are going through one of those turning points. In fact, it's only the third one he's witnessed of such a large size in his career. So large, in fact, that he calls it a sea change, which, if you're not familiar with it, is a complete transformation or a radical change of direction in attitude and goals. So now let's go through those three sea changes and see what we can learn from them. Sea change 1 is to do with risk versus return. Marks recounts how when he first started in the investment industry, everybody thought that you should just go for super safe companies. These were blue chips like IBM, which were really sound. And if you went for these stocks, people thought, you didn't have to look at valuation at all. Even if you were hugely overpaying for the stock, you'd be fine because it was a great company, right? Well, not so much. In fact, the index, which was known as the Nifty 50 at the time, suffered huge losses. And that's because people had just overpaid massively for the stocks. Many of them were hugely overvalued and trading at price to earnings multiples of over 50 times. Such that during the sell-off in the years that followed 1972, you can see that these stocks went from hugely overvalued to hugely undervalued relative to the S&P 500. So one of Howard Marks's early lessons was that it's not just about buying good companies, it's buying them at the right price that matters. And the way he describes it in the memo is to say that for these stocks, everyone was sure there was no price too high. But if you bought the Nifty 50 when I started at the bank and held them until 1974, you were sitting on losses of more than 90%. Now, if we turn to the bond space, which is his specialty, at the time, financial advisors, or fiduciaries as he describes them, simply wouldn't let their customers buy sub-investment grade corporate bonds. So if you're not familiar with that, sub-investment grade or junk bonds are any bond with a credit rating of BB or lower. Because at the time, the way people thought was to say proper financial behavior meant that you had to avoid risk at all cost. That all changed largely thanks to people such as Michael Milken in the mid-1970s. What Milken said at the time was quite radical, which is that it's okay to invest in non-investment grade bonds. All you have to do is ensure that the bond income sufficiently compensates you for the risk of default. Now, Milken himself went through quite a few scandals and spent some time in prison, but his message about buying sub-investment grade bonds has now become pretty mainstream. And Howard Marks quickly specialized in sub-investment grade investment. So he says in 1978, he started investing in these securities, junk bonds, the bonds of perhaps America's riskiest public companies. And I was making money steadily and safely. Now in 1978, it was a tiny asset class. The entire high-yield bond universe was only worth about $2 billion, whereas nowadays it's worth over $1 trillion. In fact, if you look at the latest financial stability report, this is from the Federal Reserve, you can see that high-yield and unrated corporate bonds are worth about $1.6 trillion in the US. But what's also interesting is the change in mindset at the time. And Marks says that young people joining the industry today would likely be shocked to learn that back then investors didn't think in risk-return terms. Now that's all we do, ergo a sea change. And you've probably seen me use these risk-return plots a great deal in my videos. We just take them for granted. Now, before we move on to Sea Change 2 and 3, let me just quickly mention NordPass, which is a great way to securely manage your passwords across all of your accounts. Now, if you have multiple investment accounts, as I do, it would simply be crazy to write it down on bits of paper, because that way my passwords would not be secure. But if you use a password manager like NordPass, that way you can keep it secure and also synchronize your passwords across up to 6 devices. For example, your laptop, which you can see here, or your mobile devices and tablets. So your passwords will be synchronized across all of these devices. Now, what I like about NordPass particularly is that it works across multiple operating systems. I use Linux, and it's great that there's a desktop version which you can see beside me, which works on my system. And it's not just about passwords, which are seamlessly filled in as you browse across multiple devices. You can also store secure notes, but also credit card details so that you don't have to fill them in every time. Now, as a viewer of PensionCraft, you get a special discount from NordPass where you get 1 month free and a 30-day money-back guarantee. And you can see that overall, that 2-year plan gives you a 50% discount. But you can also go for the 1-year plan or the 1-month plan. To get access to that, simply go to the URL nordpass.com/PensionCraft, or at checkout, use the promo code PensionCraft, the name of our channel. You'll also find a link to that in the description below me. Now let's look at the second sea change in Howard Marks' career, which is falling interest rates. So beside me here, you can see interest rates in the United States for US government bonds going back to around 1960. Now there's a lot of detail here, but the general trend is one of rising rates between 1960 and 1980. But since the early 1980s, what we've seen is a steady fall in interest rates, which has carried on for 40 years. Only recently have we started to see interest rates increase again. And in his memo, Howard Marks says that I consider it nearly impossible to overstate the influence of declining rates over the last 4 decades. And the beautiful metaphor which he uses is one of these walkways. Now, if you've been to an airport, you know how it works. Your speed suddenly increases because it combines the walkway speed with your walking speed. And similarly, decreasing interest rates have given a boost to almost every asset class, bonds, equities, and they've even spawned entirely new asset classes. How does that work? Well, for starters, you get faster GDP growth when interest rates are lower because it stimulates the economy. Borrowing becomes cheaper, so people can get credit and spend more, and also companies can borrow more cheaply and expand their operations. So this has also been great for profit growth for US companies, and we have seen incredible returns over this falling interest rate period. Now, it isn't all good news. It's good news for borrowers, but it comes at the cost of lower interest payments to lenders and savers. But primarily what's happened is that the cost of capital, if you're a business, has fallen quite dramatically over those years, and that in turn has increased the profitability of US companies. In the tech sector in particular, we've seen spectacular growth, and some of that growth has benefited hugely from lower interest rates. The overall effect has been to raise asset prices because the price of an asset is the value of its discounted cash flows, and when interest rates fall, the value of the company increases today. We know that happens with bonds, but it also happens with stocks. As a result of that, price to earnings multiples have risen, so stocks have become more expensive, and it's had a trickle-through effect into consumer behavior, because if people feel richer, they'll spend more in the shops. So the wealth effect has also benefited the overall economy. But there's a downside to all of this, which is that the prospective returns have reduced as valuations have increased. It's a simple fact that if you buy stocks when they're very expensive, it reduces your long-term return. Now, if you're somebody that invests with leverage, in other words, you borrow money to invest, this has been a bonanza period. That's not just true of individual investors. Maybe they bought stocks on margin, for example. It's also true of private equity, where leverage buyouts are very common. So if you buy a company, you can issue debt in the name of that company, and there's a huge demand for high yield debt now, as we saw. But if interest rates are falling, that leverage isn't necessarily a problem because the company can easily afford to service that debt. So the whole asset class of private equity essentially has had an incredible period for the last 40 years. In fact, Howard Marks says that the private equity industry owes its existence to these falling interest rates. Now, the period after the global financial crisis took these low interest rates and pushed them to the max. Essentially, interest rates were zero over the period between 2009 and 2021. And this is the way Howard Marks describes this period. And notice these are all qualitative attributes, these aren't quantitative. But the Fed's behavior was highly stimulative. The recovery took a very long time after the GFC. And over this period, inflation was largely dormant despite huge money printing from the Fed. The economic outlook was largely positive. The likelihood of distress was minimal. The mood was optimistic. Buyers were eager. Holders, once you bought an asset, were complacent. That's true of equity and credit. And the key worry of investors was fear of missing out during this huge rally. Risk aversion was essentially absent. The credit window, if you wanted credit, was essentially wide open. Financing was plentiful. Interest rates were the lowest ever. Yield spreads were modest, but the prospective returns were the lowest ever. And that's because of these very high multiples. If you look at price to earnings multiples, for example. But then in 2021, all of this came to an end, a very abrupt end. And that finally brings us to sea change 3, low return to full return. So almost all of those qualitative attributes from 2009 to 2021 have now been reversed. The Fed's gone from stimulative to tightening. Inflation's gone from dormant to a 40-year high. The economic outlook's gone from positive to recession. And almost every other attribute has turned negative. Most important from the point of view of investors was that we went from FOMO, feeling left out from the incredible rally, to being worried about investment losses. And this is as equity markets sold off sharply in the United States and elsewhere. In the credit market, which is, remember, Howard Marks' specialty, the credit window went from wide open to constricted, and financing went from plentiful to scarce. Now, what's interesting is what he says about interest rates, which went from the lowest ever to something which is just normal. And I think it's easy to forget that interest rates at 5% at the long end of the curve are absolutely typical. And a Fed policy rate, which is above 4%, is also not unusual. What was really unusual was that period from 2009 to 2021. But the good news that comes with this is the prospective returns are now more than ample, particularly in credit. And Howard Marks bemoans the fact that during the period between 2009 and 2021, all of his slide decks said things like making money in a low return environment. And that was particularly true of credit. So if you look at the US high yield market, over the space of just 6 months, we've gone from a yield of 4.2%, which is the lowest it's been for decades. It went all the way up above the long-term average, which is around 8%, to something like 8.5% currently. Now, if you look at the return on equity long-term, that's also around 8.5 or 9%. So suddenly we have an asset class which can compete with equity. And as we saw, as long as you're cogent of the risks, I think high yield is definitely an interesting asset class. And the way Howard Marks describes it is to say that even after allowing for some defaults, high yield bonds are now likely to deliver equity-like returns. And let's finish with Howard Marks' outlook. Now, I think it's fair to say that 2022 has been characterized by a series of bear market rallies. As equity markets sold off, people kept on buying the dip and making equity rally to a slightly lower high. And that's happened about 3 or 4 times now. Now, the psychology of the people who buy into these dips is as follows, according to Howard Marks. The usual trigger for buying is that people think inflation is now easing. As a consequence, people think that the Fed will soon pivot from a restrictive policy, that's a high interest rate, back towards a stimulative policy rate. In other words, people think that interest rates will return to the low levels we've been used to. If there is a recession, people think that it'll be averted or it'll be modest and brief because the Fed will come to the rescue. And there's an overarching belief that the economy and markets will return to the halcyon days that we saw with zero interest rate policy. Now, this buy the dip mentality flies in the face of what the Federal Reserve's been saying, and Howard Marks is quite negative about going back to zero interest rates. But he says what will create a turning point for the Fed and make it less aggressive with its rate increases is when it starts to see the federal funds rate becoming positive in real terms. In other words, if we subtract the core inflation rate, that's the one the Fed looks at, from the federal funds rate, which is the Fed's policy rate, until recently it's been deeply negative. Inflation was running at 10-ish% and the Fed funds rate was well below that. What we're seeing now is that it's not far from positive territory. And that, according to Howard Marks, is what it'll take for the Fed to ease off its rate increases. Now, the neutral rate, the rate at which the Federal Reserve's policy is neither restrictive nor stimulative, is roughly what we get when we look at the Fed's long-run rate. And we can get that from the Summary of Economic Projections, which is published by the Federal Open Markets Committee. Now, you can see that neutral rate has come down over time. So in 2013, it was above 4%, and the FOMC now gauges it to be around 2.5%. And their current policy is well above that. So they're deliberately having a restrictive policy, and they expect that that's going to go up to 5% by the end of next year. But once inflation comes back under control, Howard Marks's point is that we're not going to go back to zero. That zero lower bound is gone. What we'll go back to is this long run rate, which is around 2.5%. In other words, the halcyon days of free money are over. So to summarize his outlook, Howard Marks thinks that inflation and rates are going to dominate investment for the medium term. You can just look at market reactions when inflation is below expectations to see that that's true. On the inflation outlook, he's very modest. He doesn't try to produce a hard forecast. What he does say is that inflation will remain higher until people's savings are spent, and that brings supply back into balance with demand. A longer-term trend, which he describes, is that globalization is slowing. For example, the manufacturing of chips has been onshored back to the United States. Now, that's going to be inflationary because instead of trying to source goods and services from the cheapest source globally, countries are instead choosing to go for a potentially more expensive local supplier. As a consequence, he thinks that's going to bump up inflation by around 0.6%. He thinks a Fed pivot is very unlikely, particularly when the Fed funds rate is negative in real terms. And he thinks a return to 0 to 2% is very unlikely. It's much more likely that we'll go back to that long run rate, which is in the 2% to 4% range. And overall, the outlook is just less rosy. A US recession is looking very likely, and it looks like corporate profits, earnings in other words, are likely to fall. And when it comes to credit, it's very likely that if we get a recession, we'll get a pickup in the default rate. And that's going to be negative for the credit market. And for a credit fund manager, that's great news, because what it means is that investors can now get solid returns from credit instruments. We saw that in the high yield market, the returns are now around 8.5%, which is equity-like. And you don't have to take a great deal of risk to generate that return. So instead of going for these lottery ticket investments, such as call options on Tesla, or NFTs or cryptocurrency, you can now invest in conventional markets and still achieve a pretty good long-term return. And that's a positive outcome. So it's certainly not all negative when he's talking about this sea change. There are definitely positives in his outlook. I can see what Warren Buffett means when he says that he always learns something new from Howard Marks's memos. I certainly learned a lot from this one. And I think it's always useful to look at what these really seasoned investors think and also their macro outlook. Even if they're not right, it'll certainly give you ideas about what's going on. Now, don't forget our offer from NordPass. If you want to securely manage your passwords across multiple devices, you can learn about how to do that and get our special discount code by clicking on the link in the description below. And, as always, thank you for listening.